80-85% of consumers do not buy the cheapest product. For each of those companies to give you 150 crores or 200 crores at 5% ownership, it means you have to exit all of those companies at a valuation of 4,000 crores. India is not the market for the outsized returns that you can probably, let's say, get in the US. If you believe or if you do not believe that a brand plays a role in your decision making, 9 times on 10 you're not thinking right.
So let's say the company has reached that point. They've raised 3 to 5 crores from you. What do they raise next? How much should they raise next? The unicorn founder tells me that, bro, 2 years ago, everyone's being valued at 40x. If I didn't take a 40x deal, I'm the idiot.
I don't fault the founder, I don't fault the early investor. I actually don't even fault the guy who probably gave that valuation at that point of time. For the first 3 to 4 years of a company's life, a founder genuinely needs a lot more of your time. The kind of money we are offering is not earth-shattering. A lot of founders who raise $500,000 from us can actually easily raise $2 million from somebody else. But they're kind enough to raise that money from us because
Ladies and gentlemen, welcome to yet another episode of the Numbers Game. Today I have somebody who's a little bit more low profile in the media, but actually fairly well connected and pretty central to the Indian startup ecosystem. His name's Anshu.
Thanks, Varun. Thank you for having me.
First question, right? How did you get started doing this? Like, did you have like an angel investing career? What's the path and what do you do today? Like, how do you describe your job?
Like everything else in my life, I think this happened mostly by chance. So I started my career in banking. I was an investment banker when a random LinkedIn post in 2012 took me to, at that point, a completely unknown asset class called venture debt. This was Silicon Valley Bank's India business. It intrigued me. I went and met the people running it, Ajay and Vinod. Loved the conversation, and somehow, and working with Ajay and Vinod was an interesting opportunity. It was also the time when the Indian venture capital ecosystem was just about to take off. So venture debt was an interesting break because for me, I kind of come from a tier 4 or maybe tier 5 town, had limited to zero exposure to the startup ecosystem in my prior life. So every single day was interesting, getting to meet entrepreneurs, trying to change the way the world works. Most of the times I wouldn't believe them, which helped because venture debt works on significant amount of risk mitigation, but helped me build a network which was very useful in my future life. One of my early venture debt bets, actually my second venture debt bet, was a company called Freecharge, which is where I happened to meet Kunal and my current partner Sandeep. And early relationship of asking a lot of questions to Freecharge. 2 years hence, Freecharge got sold. In 2017, I decided to shift from venture debt to venture capital, moved to Sama with Ash. But one thing led to another, and a couple of chance conversations with Sandeep led me to move back to Mumbai.
Sandeep was one of the co-founders at Freecharge.
Sandeep and Kunal were the co-founders of Freecharge, and Sandeep and I, after the exit to Snapdeal, started actually having more conversations around the early genesis of what we tried to, or we are trying to build at Whiteboard. Started in 2015, 2016. And it came out of a coffee conversation with Sandeep. So 2018 is when we eventually started with Whiteboard, and yeah, now it's been almost 6 years. Whiteboard came out of an idea that both of us very firmly believed in, and we felt that fund like that could be interesting for India. There weren't too many of the sort at that point of time, and maybe we'll come to that subsequently on how we thought of Whiteboard a little differently. But yeah, I think that's quick answer to how we got started.
How much did you guys raise at Whiteboard?
So Fund 1 was a 77 crore or at that point of time what was almost $10 million at currency. We then raised Fund 1A, because some of the fund one companies did significantly well, so we needed some more capital to fund, and we've just closed our second fund at 300 crores.
Wow.
So yeah, I think that's between the three funds put together, we would roughly have around 450 odd crores of deployable capital, of which Fund 1 and Fund A are almost fully deployed. Fund 2 is something that we're currently deploying.
Wow. So you guys started at a $10 million fund. I mean, a 77 crore fund. Now it's like nearly 300 crores. So it's like, it's been a step up for you, right?
Yeah.
Interesting. Tell me one thing, Anshu. What do you do on a daily basis?
So I think at Whiteboard, I would say if I break my normal day down, 65 to 70% of my working day is spent working with portfolio founders. Typically, it would start normally at 8:39 with some update
Crisis.
conversations, very quickly moving to some fire in some portfolio company, which we're trying to solve. But by design, we are focused more on the building part and lesser on trying to find the next big thing or prospect the next big opportunity. We've been lucky that I think deal flow hasn't been such a major problem for us, and that helps significantly because you're able to actually focus on doing whatever is needed in a business, whether it is hiring a new resource, finding a co-founder, solving a specific issue, working on digital marketing, whatever the issue may be. But I would say not just for me, but for most of the team, I think 70-75% of our day is spent on portfolio related stuff, and the remaining 20-25% will probably be speaking with prospects, trying to meet investors, co-investors, partners, investment bankers in some scenarios, or at board meetings, etc. But that's broadly how I think most of our days are.
How does one go about raising a 300 crore fund? People in the audience might think it's all, the money of the VC himself, but actually you're raising money from other people.
You have, depending on how large a fund you raise, you have a specific set of investors or LPs or limited partners, as we call them, who are willing to bet on a strategy with a GP or a general partner.
So you are a GP?
I am a GP. Sandeep and I are the GPs, and we have a whole lot of LPs who've trusted us with their capital.
So about 100 people, 200 people, something like that?
Yeah. So I think in our case, I think it'll be probably 50-55, but okay. it could be any number. But those investors then provide you with, so basically you make the same way founders pitch to us for fundraising, the same way we pitch our strategy to those LPs. So LPs at the upper end of the curve could be anything from large global endowments to large global multilateral organizations like IFC, to domestic institutions like SIDBI. People who have enough capital to deploy in this extremely risky asset class. And there are kind of two different formats. You could have a global offshore fund, or you could have an onshore fund like we do, where it is approved. It's a alternate investment fund approved by SEBI, where every single investor has to, at the lowest, contribute 1 crore of capital, which is again driven by SEBI's investor protection regime, where they want to ensure that anybody who invests in this extremely risky asset class has enough capital, so that even if this goes to nothing, the investor understands the risks associated with the investment. So I think that's broadly how you kind of end up raising a fund.
Interesting. So I'm going to say some very stupid things, right? Let's say I was a VC for a second, and I'm talking about early stage, right? Yeah. I know there are multiple stages. You have early stage where you're investing on a whiteboard idea. Then there's a Series A where the company has just demonstrated some traction.
True.
Then you have the later stage as the company proves more and more things, right? So A, I want to know how those stages work. But B, let's say if I was a VC, early stage VC, One strategy that I've seen all these early stage VCs do is, okay, I have 300 crores. I put 1 crore in 150 companies, and then I keep, so 150 crores I've spent. The other 150 crores I'm keeping in my bank as reserve, where if one of those, because 90% of those companies will fail, let's say 5-10 of those companies do very well, I have the other 150 crores to keep pumping in their future rounds to maintain my ownership. Lots of people call this the spray and pray strategy, right? But you're not a big fan of spray and pray, right? So I want to know, what is a mistake that many spray and pray investors are making, in your opinion?
Instead of commenting on their mistakes, I think let's kind of look at it first principles on why we started Whiteboard in the first place, right? And going back, for us, it was important. It is important to be a part of their journey with the founder, where the thesis, the space the founder is building in, and we've been crazy enough to invest in sectors, in spaces where conventional wisdom would necessarily not suggest that an outsized return is possible. And if you look at a strategy, right, a fundamental investing strategy comes from a point of view of, if things go to plan, what do you expect to get out of it? Our thesis, and where it differs from some of our peers, is that India is not the market for the outsized returns that you can probably, let's say, get in the US. There are some fundamental structural things about India which make us, for ourselves, question our ability to generate those kind of exits. And let's take the maths up, right? So in conventional logic, let's say I was to invest 1 crore in 150 companies, and my assumption starting out is 90% of those companies would not play out, which means 135 crores gone. The remaining 15, even if I assume that I invested in each of those companies at a post-money valuation, and post-money valuation of 10 crores, means I own 10% in each of those companies, which, by the way, is very generous from an ownership point of view. It's very difficult to get that kind of ownership today with high quality founders. But even if I was to play along with that argument, the broader expectation is that every single company that works out for you ends up giving you 150, 200, 250 crores as a return. Now, a company where you're owning 10% at inception, high probability by the time an exit event comes around, because there are subsequent rounds that happen in the company, you would be diluted down to a 5% or 6%. Now, for each of those companies to give you 150 crores or 200 crores, just for easy maths, at 5% ownership, it means you have to exit all of those companies at a valuation of 4,000 crores. Till date, barring companies that have gone public and Flipkart, I don't know if any other company in India has given that kind of, like, has had a cash exit of greater than $1 billion for the investors. If I keep Flipkart out and the technology companies that have gone public.
And the outliers like Freecharge and all the others.
Even Freecharge was a $400 million exit. It wasn't $1 billion exit. Snapdeal bought it for $400 million. It wasn't billion. And $400 million for the whole company. So an investor would have received a percentage of it, depending on how much they owned and how much they had invested. So our investing thesis comes out of our belief that we are not sure if that maths necessarily holds up in the Indian context. And I'll also add a couple of qualifiers here, that we've by design chosen to invest in a few sectors that are not necessarily the most
lucrative for exits.
Crazy in terms of growth. I think they're lucrative for exits. For example, consumer brands is one of the places where India has probably seen the maximum number of exits. But the amount made per deal may not be that high. But they are not necessarily your crazily spoken about companies, because an exit may even be a $200 million exit or a $150 million exit. If you think of it in real Indian money context, 1,000 crore exit is not bad. But when you are investing in many companies hoping to get 150, 200, 250 crores from a single company, it is
Not enough.
it is reasonably hard to get that outcome until and unless the outcome itself is 3,000, 4,000, 5,000 crores in cash. Because what I'm not counting here is exit through stock, exit through any non-cash means, because that still doesn't come back to you. You may get shares of another company which may be valued significantly higher, but at some stage, that stock has to convert into cash for you to return to your investors. So for us, the strategy has been to go deep on our own conviction on the space, create enough reasons for us to want to back anybody building with the right parameters in that space, and then work closely with the founder to try and make it happen. But the multiples at exit we work with are reasonably subdued, because for me, I'm happy to put 5, 6, 7, 8% of my fund in a single company.
So you're saying you're okay with putting, let's say, about 25 crores in a company if you think is going to win?
Over a period of time, yes. I would probably start with a 3 to 5 crore check. But if the company is showing all the right signs to me, I am more than happy to double down on that company, so that see, this business, right, is also all about ensuring that if you know you have a winner,
You bet hard on it.
you bet hard on it, because you do not want to miss out on ownership in that winner in favor of a company that may or may not play out. So if in 18, 24, 30-month period, I find a portfolio company to be in significantly top decile of not just but my co-investors' portfolio as well, it makes all the sense in the world for me to stay invested for longer, rather than try to look for a new deal at that point of time, because doesn't happen very often. And that's the reason why we were willing to take fund to all the way up to 300 crores, largely because I wanted to ensure I have enough dry powder to keep investing behind winners as and when those winners come through, rather than losing my stake at the cost of dilution because I did not have capital to invest, which is one of the issues I faced in Fund 1. So I wanted to ensure that if I was getting to go to 300 crores thanks to the trust of LPs, it made a lot of sense to go to that number, so that I have higher amount of dry powder to put behind my winners as and when those companies start proving out their potential.
So and tell me what you guys are a very early stage fund, let's say. You guys come in at the earliest stages. So you're putting roughly 3 to 5 crores check in a company, and then let's say about 50% of your fund you're deploying, and the other 50% is just reserve.
So in Fund 1, we ended up deploying approximately 65% in the first check, but that was also because the fund size was significantly smaller. Fund 2, of the three, so the way again the VC maths works, right, is that of the total fund raised, there is a portion of the fund that goes out as management fees, which fundamentally means that money is not invested, but it goes out to the fund manager or fund
That's
management
2% a year.
Yeah, it is between 1 to 2%. So I think if I take, let's say again, 300 crores of 300 crores, in our case approximately 30 crores, because we are at a 1% structure, 30 crores will go out and will not be invested. So 270 crores is the amount that will be invested. Of the 270, 120 is what we will invest as a first check into companies, and 150 is what will be kept as reserves to be invested into any and all companies that perform as per our standard set. by those companies. But yeah, that's the rough match. So 120 first check, 150 follow-ons, and approximately 30 crores of management fees.
And roughly in every new company, you're putting 3 to 5 crores.
So it would be, yeah, so in fund 1 that number was smaller, but yeah, in fund 2 that numbers move between, I would say, 2 to 4. 5 is an exception for us. But 2 to 4 crores is what our preference is. As I said earlier, almost all of our companies are at pre-inception, pre-product ideation stage when we come in. So at that point of time, for that 2 to 4 crores, we are able to get meaningful enough ownership for us to want to work with the founder to try and make the company or business
more successful.
Yeah.
Okay, tell me one thing. You are an early stage fund.
Yeah.
And I assume there are funds beyond this.
Yes.
So your responsibility is to take the founder to what milestone? And then what are the milestones beyond that?
I think the first and the most important responsibility is to work with the founder to build a product that works, because as I said, we come in at pre-product stage. So having a minimum viable product, whether it is in consumer brands, financial services, technology, B2B, whichever sector, there is a so typically what we do when we invest is we create a document internally and agree on. So there's a commercial term sheet, which for us is a significantly simpler document. But this second document that I'm talking about, where the strategy of what are the success metrics that we have to hit in a period of time, are the ones that actually take longer for us to agree with the founding team on. And those are more important for us than the commercial terms, where we work with the founding team. We share our thesis, they share theirs. We've come to a point where we've decided to invest in a business. So at that time, we would actually sit down with those founders and put down our definition of what success will look like. Now, in some businesses, it could be what is called product market fit for the product. In some businesses,
can you explain that for the audience?
Yeah, of course. So for a business to get to a point of scaling with additional capital, you need to prove that whatever you've created, whether it's a tech product or a physical product, is needed in the market at the price that you're selling.
And people will willing to pay for.
And people are willing to pay for it at a reasonable scale. So, for example, we funded a men's innerwear brand in 2018 October by the name of Dimensh, where our conversation with Gaurav and Anurag was all around at what scale of return on ad spend. And what return on ad spend basically means is if you're a website, you typically spend some money marketing over Instagram, over Facebook, over Google to try and bring consumers to come and try your product out. So on every 100 rupees spent, if you're able to get, let's say, 200 rupees of revenue from customers through purchases, it means your return on ad spend is 200 by 100, which is ROAS of 2. So we had an ROAS number in Dimensh's case, which was one of the success metrics. Given underwear is not a very high repeat category.
So people buy once but not come back again.
People typically would buy, like, it was after our consumer service, we realized that customers would buy twice a year, because we used to sell, our biggest selling SKU or stock keeping unit was a pack of 3, which means if you bought 2 packs of 3 or 6 underwear in a single shot, high probability your next purchase will only come 3 to 4 quarters from then. So we couldn't put repeat as a, and again, if I was to kind of compare that to, let's say, Atraya, which is a subscription hair fall solutions company, there the core metric for us was the repeat metric. That if you bought the first kit, how many customers are buying the second and the third and the fourth? Because it's a subscription kit, the customer's belief in the product is only evidenced by them buying the kit again and again. So to come back to the question, right? So in every company, we would put together these success metrics, which to us are the primary responsibility, where it's an arrangement between us and the founders that first we have to achieve this. Once we achieve this, then we will figure out what the next milestone should be. And typically you would take anywhere between 6 to 18 months, depending on, so in a hardware company where you're actually building a fairly sophisticated hardware product, you would maybe take 12-15 months to first get the product out, and because in hardware you have to be very, very right with your first launch itself, so you give it enough time before you bring it to the market. Whereas in a Dimension or a Traya, you may have a faster path to market, but your success metric may be different. But as you mentioned earlier, right, so there's a bunch of investors who are typically right after us, who will invest in businesses after they see early signs of a product market fit. So getting the company to that point and ensuring that you are able to, within the broader realm of investors, partner with the right investors. And given I've been around in the space for now 12-13 years, I have a reasonable view, correct or incorrect doesn't matter, but I have a view on for which kind of companies, what kind of investors probably make more sense than others, because we've seen investors invest in all kinds of stuff, but we've also seen investors who've been more helpful vis-a-vis less helpful for certain types of businesses. So I think our, as I said, primary responsibility is to get to early signs of PMF, try and see if we are able to bring additional capital into the business to get to the next level of growth. Our responsibility doesn't stop there, but that's kind of the first step, at which point we are able to confidently state that something in this business seems to be working. And then you obviously keep building on top of it, because building a company, right, is a continuing process of improvement. So you keep changing your success metrics as you go along. But defining those success metrics actually, I think, defining those success metrics right is, I think, one of the biggest things that we try to bring to the table to ensure that between the founders and us, there's complete agreement on where to get to.
So let's say the company's reached that point, they've raised 3 to 5 crores from you. What do they raise next? How much should they raise next? Let's say it's a D2C brand.
So in a D2C brand, you typically, the next round would be anywhere between, I would say, $1.5 to $3 million. So anywhere between, I would say, 9 to 20
That's
crores.
a seed round?
So seed, pre-A, so there are various terms that you typically would use. And as I said, depending on the stage at which the company is, if they've shown more progress than you expected, the round will be closer to 20-25 crores. If they've shown lesser progress than you would have liked, the round could actually be between 8 to 12 crores. Another key nuance about D2C brands, for example, is that D2C brands are high margin product sales, which fundamentally means that business intuitively should need lesser capital to scale. And when I say lesser, it is relative, but lesser as compared to a consumer tech play or a hardware play. So if I was to compare a Dimension and a Myntra, Myntra is a platform which is trying to bring significant amount of traffic to the website. It would need a lot more capital to bring meaningful enough traffic, whether it's a Myntra or a Nykaa or a FirstCry or any of those marketplace plays, because they are one of the core metrics for them is the traffic that they've been able to bring to their websites and how much of the traffic converts and how much sales are they able to get. So for them, traffic's an important parameter, whereas on the Dimension website, traffic doesn't matter. Conversion matters. What campaigns are working matters. As I said earlier, return on ad spend matter. So a D2C brand, because you have between 65 to 85% gross margin on anything that you sell in most D2C brands, the amount of capital you need to scale up to a certain size should not be that high, because thanks to all the innovations that have happened over the last 7-8 years with website creation being eased out, with G2C payments being streamlined, with a whole bunch of,
you don't have to do any of the hard work anymore.
You don't have to create it for yourself. There are enough tools available which you just plug in. If your product works and consumers need that product at the price point you're selling it at, That should be the only core thing you should be focusing on.
Can I ask you a weird digression here?
Of course.
Do you think like D2C at least, and actually many other spaces, do you think it's becoming more about brand than anything? Because even the product technically can be commoditized, no? Or has started becoming commoditized. Let's say with earphones, right? There are like 50 manufacturers from China you can reach out to on AliExpress and they'll deliver for you. And same with D2C products, right? I'm sure some moisturizer is if you do 10 minutes of research, you can find who's the supplier. And then it's about packaging and the brand.
So academically speaking, right, D2C should always have been about the brand. And again, let's keep D2C aside for a second. Let's think of our purchase behavior in general. 10 years ago, 15 years ago, there was no D2C. But even then, when you went to buy a t-shirt, or when you went to buy a pair of jeans, or when you went to buy a watch,
You always bought a brand.
you always bought a brand that you liked and you felt was appropriate for you. When you're a college going student, a different brand feels right for you. When you're in your 30s, a different brand feels right for you, but you're always shopping for brands. So if you think of it, whatever form of product commerce you take, there is, and this is not India alone, right? The world over, there is significant premium or value that is placed on
The brand.
How the brand is built. So see, D2C is only a channel. I can choose to sell this t-shirt on the Whiteboard website. I can choose to
Sell it on
Amazon. I can choose to set up a store outside and start selling it. I could choose to take place in one of the malls in Koramangala and end up selling it there. But what you'll come to me for is
the name.
If you feel Whiteboard is aspirational enough, Whiteboard has communicated something to you which makes you believe that I need to own a Whiteboard t-shirt, is when you will come into my store. So, and it's not just in commodity, or commodity type spaces, as you said, in earphones, right? In every single category of D2C brands, it should always be brand first. And that's where the dichotomy starts. Brand building is a process of patience. Venture capital is all about impatience. Venture capital is all about finding results fast. Brand building is a gradual process.
Building trust takes decades.
Yes, because by spending $30 million in a month, you're not going to make me believe your proposition that easily, until and unless there is some element of trust, aspiration that you are able to communicate along with that very strongly. The capital you spend is only a means to an end. So that's where, I tell this to many consumer brand founders, right? A consumer brand company starting with a significantly large fundraise, 8 times on 10, in my view, will go through some issues later in their life.
If they raise too much money early.
If they raise too much money too soon, because there are things about that business that you just cannot hack with extra capital.
It takes 5-10 years to build that brand anyway.
Yes, and if you think of it as a consumer, you're able to see why. Like, trust is not something that can be bought by buying all hoardings on a road. That is not how trust manifests. Trust has many layers depending on the category you're selling in, but if you inherently understand that it will take time, only then will you also understand that the biggest raw material is actually not capital, but the thinking behind why the brand needs to exist. Why should a consumer move from
their existing underwear
company to Dimension, or their existing natural product to Nat Habit, or their existing fan company to Atomberg, or their existing skincare regime to a different skincare regime? See, each one of those are shifts in consumers' view towards the better.
So you're saying ultimately you build a brand because you're trying to shift a consumer behavior, and you only make real money when you shift a consumer behavior. So you're saying all of the entire venture capital game is purely about shifting consumer behavior in a way that benefits your company.
So I wouldn't say shifting consumer behavior. I would say giving a consumer something that either has not been given earlier.
So some differentiated product.
So either some differentiated product or some differentiated positioning to kind of, as I said, I'm saying if I take brand examples, right? Attenborough came into a reasonably commoditized fan market and offered initially as a B2B product a fan that saved electricity. Now, intuitively speaking, you would believe that fans are not such a big energy guzzler. Why should I care? All of a sudden, you come in with a technology play where you've said that I have made a brushless DC motor, which ensures that this happens and fans the product, especially in the hotter markets, you use a lot of. Now, all of a sudden, Attenborough, when it shifted the narrative to energy saving as a feature for a fan, everybody else followed suit. The much larger brands started also following suit with their own energy efficient products. Those companies had been in existence for decades. And it is not that they couldn't have introduced the same thing. It is just that probably they felt, we're not sure if this needs to be introduced. Attenborough brought in a very significant change to the market dynamic. All of a sudden, consumers started gravitating towards that. And every other old school brand also had to innovate and come up with offerings of their own. And Traya, we came up with an online test, a diagnostic test that you take to figure out if you have hair fall, at what stage of hair fall you are. There's stages 1 to stage 7. If you're in the stage 1 to 4, we would actually give you a diagnosis real time and send you a kit of products which have Ayurveda, allopathy, and some diet restrictions to help improve or reduce hair fall for you. And there's significant amount of literature, and we actually appointed a hair coach who will talk to you on a regular basis and help you get through the journey.
And that's very different from you just going online and buying like a regular hair product.
Yes, and that's a company where we built it on the philosophy that we will never be successful selling on marketplaces. So 99% of our revenue even today at a significantly scaled up number
is from your website.
Is from our own website.
Can I ask you a question? Why do you say that you don't make money selling on marketplaces? Because of the tax that Amazon takes?
No. In Traya's case, because of this diagnosis that you need to do and sell a subscription, there is a significant amount. So the customer actually spends 8.5 minutes on our website, first filling that questionnaire up, basis which you give a diagnosis. Post the diagnosis, the product is given. E-commerce marketplaces are built for pure product shopping. They're not built for that experience. So in Traya's case, we had to kind of shift the game. And also, I think this is one line of brands, which is product. There is also significant brand building when it comes to whether it's a financial services play, whether it is a tech play. In fundamentally, if you believe that, or if you do not believe that a brand plays a role in your decision making, then you're not, 9 times on 10 you're not thinking right, because 85% today of your service decisions are also driven by your view on brand.
What do you mean by service?
Let's take Cult Fit. Now you're willing to pay a premium
because of the brand,
because of what the perceived value Cult gives to you as compared to any other neighborhood gym. Now it has, over a period of time, proven to you as a user, me as a user, that this is quote unquote higher quality. And actually in service, right, higher quality is even harder to measure. You're willing to pay a higher fare to a certain airline versus another one. You are willing to pay higher room rental to a certain hotel chain versus another one. If you look at all of them, every single decision that you are taking with respect to how much I spend on what part fundamentally comes from how you feel that brand is going to impact how I am perceived.
So it's not just the brand. It's if I buy this brand, how will my brand improve in my peers' eyes?
Exactly.
That's ultimately
and all of us, right, are behaviorally playing that game where there are a certain, like all of us, and this is, I'm sorry, I'm kind of probably going into a very unrelated loop, right? But 95% of us, I would say, if not higher, are fundamentally playing for relevance. Relevance in front of somebody.
Our
Now,
peers are.
Could be peers, could be parents, could be spouses, could be girlfriends, could be boyfriends, could be kids, could be grandparents.
So all these brands are sort of a way to hack the social game for yourself.
Yes, and you are able to create your own presence in that social sphere where whatever is relevant to you, whoever is relevant to you, all of a sudden feels that your game is worthy of their attention.
So I'm just going to summarize this, right? So far, venture capital, early stage venture capital, where you come in, is build the product, build a differentiated product. Then every round of capital beyond that is build a brand, build a team, and obviously the team is helping build a brand. Once you've built an established brand, then it's harder for somebody to come and disrupt you. And therefore, the ultimate goal of venture capital is to build brands, not necessarily companies. And the company is a side effect of the.
So I think the way I would probably go about it is you, especially in the consumer sphere. So, and again, in some spaces, in every space, it'll probably be a different answer. But if you are not a relevant enough brand,
You're going to die.
The company side of it, which is the numbers that come with it, the financials that come with it, may not be as permanent as they seem.
So you'll have a good this year, but you've not built a brand, so your next year is bad.
So an emphasis remains an emphasis for a longer period of time, because over a period of time, brand emphasis becomes more important than the financials underlying it. So the classic example, right? Maggie. Maggie, the brand, became so powerful that even after a 1.5 year ban, they came back, and the year after that, their numbers were stronger than even before the ban. At the end of the day, it's a noodle.
Anyone can make a noodle.
Anyone was making a noodle. When Maggie was banned, every consumer company and their uncle had come up with a noodle brand. And I'm sure they sold as well. But the moment Maggie came back,
it remained king.
Now imagine this, right? It was a food brand. It was banned for allegedly reasons of food not being safe enough.
And it's still.
And it came back. And the same consumers who were buying it bought it with extra amount of vengeance, which showed in their financial performance.
So the company is a vehicle where the financials reflect how big the brand has gotten. I have a question here, right? Is this valued somehow, the brand? Because I guess the financials are a reflection of that brand. And so I know that the later stage you go as a venture capital firm, or when you go raise, you probably use a technique called DCF, which is discounted cash flow, right? You're saying this is how much money the company is making this year. This is how much money we expect the company to make over 10 years. Therefore, this is the valuation of the company. But the brand is not baked into this, no?
So I think there are two ways to answer this, right? So I think there's enough amount of work done in the field of valuation where actually brands are valued. IPL is valued. All of your IPL clubs are valued. And there is a significant premium put. Now, if you just flip the argument a little bit, the revenue that you make today and you'll make over a period of time has significant reliance on the brand itself. Because the reason why you're willing to pay more to a Taj hotel versus any other hotel is because you believe Taj is giving you the service that is worthy of the money that you're providing to them.
So it's anyway reflected in your financials.
So in a way, the reason why Taj can charge X amount per room night per customer is because there is a brand premium that is already associated with that, because the basic costs of a hotel operation, after the fixed costs, the variable costs do not change significantly.
Can I make an inference from what you're saying? Can
Sure.
I say that your brand is reflected in your gross margin?
Your brand is reflected in your premium against peers, may or may not reflect in your gross margins, because there are businesses that may operate on a premise where they believe that high gross margin is not good for business. What is a brand, right? If you go down, a brand is a belief system where I have a belief that I want to buy the most or the best value for money product for myself. If that is what I'm looking for, probably DMart is the place to go. Now, by design, DMart has chosen a model where they're able to every single time prove to me that
They're the cheapest.
they are the value for money is what they've chosen. Now, in that process, in their early days, they may have taken a call to give up on their gross margins, but they have created a position in my mind where DMart is very difficult to replace when value buying is important to me. And this is not just true for product, not true for service, actually true for everything you and I
I've spent money on.
Yeah.
So we've summarized that venture capital is sort of builds a brand, and we've seen this with companies like OpenAI and all, right? Like even if you build great technology, eventually competitors come. And now OpenAI is having a hard time because Perplexity is sort of starting to build a brand. So is Bard and all the others, right? But you're also of the belief that VC in India does not have product market fit, or at least patches of it, right? And what that means is even venture capital as a product, you're offering money to other people, but you're saying that might not have product market fit. What does that mean?
So as I said earlier, right, I think first is by product market fit, we fundamentally mean that somebody is willing to buy your product or service at a price where it economically makes sense for you to do that activity. Now, in venture capital, we deal in money, which means, let's say you're an investor in my fund. Once you commit a certain amount to my fund, given this is the riskiest part of your portfolio, I typically promise you 3, 4, 5x on your money. Now, for me to have product market fit across stages of company building, I need to have seen or exhibited enough number of exits where somebody has made that kind of money for me to confidently believe that it works. Now, in the Indian context, as we kind of spoke about this earlier, between a few companies that have gone public and Flipkart and probably 2, 3 others, we've not seen too many large cash exits, which means that kind of money has not gone back to limited partners for them to have the same confidence that India can become a machine that generates that kind of cash for them to keep deploying that kind of money into India. By the way, there are also some structural reasons for that belief, because I don't think India is as efficient as of now as a market, even from a consumer standpoint, as let's say the US is, because of various differences in how our economies are structured. The inequality in India and the number of haves in India is a much narrower window as compared to the total population. So we may be a country of 140, 150 crores. Only 7% of us even have a passport. So which means if you're building an outbound international or in like travel business, right, you can only work with the 9.6, 9.7 crore people who have a passport. Last year, 2 crore Indians traveled abroad. Now, once you start narrowing the pool, all of a sudden you start feeling that for you to be a profitable business, you need to make more money from the haves, but you cannot count the broader population as an opportunity.
By haves, you mean people with the money?
People with the money, because they are the ones who will actually be able to pay.
And
for
that's
the
why
services.
now all VCs have started differentiating India into India 3, India 2, India 1.
Yeah, and everybody has their own definition. Somebody defines a part of India as Singapore, and somebody defines it as London, and somebody defines it as, depending on what our respective GDP per capita in those markets is. But if you look at that, right, it is a fairly narrow spectre. Now, the reason why is it relevant? It is relevant because a venture capital business, for it to generate 4, 5, $6 billion of exit value on a single investment is increasingly hard in a business like, in a country like India, where the total number of companies in the listed universe. So I'll give you again a data point. To my knowledge, there are around 520 to 530 listed companies in India that have a market cap of more than $1 billion. And we have 125 to 130 private unicorns that are valued more than $1 billion, the definition of a unicorn. At some stage, these 125 companies have to prove their worth by giving exit to their investors.
How many of them do you think will actually give reasonable exits? Controversial question, but
Now let's assume, and I'll not name companies here, but at least I name contexts here. Now let's say a company today is doing 100, 120 crores of revenue. Is still making losses through VC capital and is valued at 8,000 crores. Now, anybody will tell you that it will take a significant amount of time for that company to, as we use the phrase in our VC world, grow into their valuation. Because a 100 crore, 125, 150, 200 crore company valued at 8,000 crores means it is 40 times revenue. You do not see that in many places. Even the hardcore tech plays
and are valued at
are
6x
not valued at these kind of crazy multiples. Now, within the universal set of these 125 companies that are already valued at 40, 50, 30, 20 times revenue, you know that they have a long way to go before they can meaningfully evidence their ability to return. On the other hand, there may be companies at 1,000, 2,000, 3,000 crores that are valued at 15,000 crores, and fundamentals that are improving year after year after year. You know that those companies will eventually deliver. So I think that emotionally, I would like to say I seriously hope that at least half of them
Return the capital.
return at least $1 billion or higher. Jan 2024, sitting where we are, I am not able to practically see that.
What number do you think will actually return $1 billion? Companies valued at $1 billion returning at least $1 billion? Current unicorns.
I'd probably say, 20%.
So you're saying there are only 20 real unicorns in India. The other 80 are sort of there, but
Yeah, unicorn in itself is mythical, right? So yeah, so I can't, as I said, because I'm basing this on financials of some of these companies that I've been able to see after they've filed FY 24, 23 numbers.
So is that why you say that VC, especially later stage VC, doesn't have PMF? Because they're the ones that came in last, put in the most amount of money, valued the company at 40x? Because I've spoken to some unicorn founders about this. You know what they say? The unicorn founder tells me that, bro, 2 years ago, everyone's being valued at 40x. If I didn't take a 40x deal, I'm the idiot. Right? My VCs were like,
No, but I don't fault the founder at all. I don't fault the founder. I don't fault the early investor. I actually don't even fault the guy who probably gave that valuation at that point of time.
Because there's so much competition.
Because there was so much going around at that point of time that it is easy for us to sit today and find flaws in that argument. But at that point of time, all of us were flying the same cloud. And in my mind, I think the more important question is, what did people do with that money? There are significant number of founders in this whole category that I know personally who were very cautious once money flew in, which also means that those guys have already planned their plan Bs and Cs and Ds. So they may take, like today's evidence, I may say that number is 20%, We meet 12 months down the line, 20 more may have grown into that valuation. Because you also have to understand those guys do not need to raise that kind of money anymore because they've been careful enough in keeping that money in the bank. They've been careful enough to cut down their burn, to keep capital with themselves. But I fundamentally believe that in the next 36 months or so, what is the ideal fund size for a venture capital fund is a question that will get discussed way more than it is discussed today, where an LP may continue to find a GP very, very compelling, interesting, and very high quality. But the question around what is the right amount of capital to raise for what strategy will become a question that will get discussed. I know from private conversations with some of the GPs who've raised large amounts of money, they are asking the same questions as well.
But now it's too late, right?
Yeah, it is for this fund, but
You can fix it on the next one.
you can fix it on the next one. You can fix a strategy. You can find answers. There are still strategies that may get you over the line.
Can I ask you a
Systemic
stupid question?
issues.
Why can't the GP wire back half the money
They can.
and cut down the fund size?
Maybe you'll see some of that happening as well.
And for those listening, the reason the fund size matters is the rough math is you need at least one company to return the fund. So if you're raising like $1 billion as a fund and you're investing in 30 companies, you need at least one of them to give you a $1 billion exit.
And for one of them to give you $1 billion as an exit, and if at exit you're owning 10%, the company has to be valued at $10 billion at the time of exit, which is not something that at this point of time for the next 3 to 4 years
We are going to see too much of.
it may happen. Hopefully it happens in a few scenarios, but I don't see it happening in 15 companies, for example. So I do see some of those not playing out, which is why and by the way, to your point on returning the fund, I think GPs always have that liberty. In other markets, I'm not sure in India, I don't know of enough examples, but in other markets, GPs have done that in the past as well. Whenever markets have turned, they have returned money, they have shut down funds, they have decided to give away money because they've not found enough opportunities in the space that they are building in. So it's happened. It's not that it's not happened. What it also has an impact on is the fee pool that you have access to. So there are operating constraints as well that you have to keep in mind.
So you take 2% to run your
Yes.
org. So you, as a VC, you probably have to lay off people.
Either lay off people, reduce how much you're paying people, like figure out an economic model that works. And that's the other thing, right? I think over the next 3 to 5 years, between right sizing, as see the same way we kind of talk to founders about right sizing their cap table. I think GPs will right size fund sizes as well, and even the fund economics, the way it works today, the 220, which is kind of taken for granted, I think that will go through its own journey of evolution as well, because it is predicated on the return profile that tech companies in the US have shown. If we are not able to show that kind of return profile, we'll still be able to raise money. But there will be hard questions, as they should be, from LPs on what is the right economic construct for running a fund.
Is there something outside of fund size that you disagree with other VCs on?
I think one thing that, and I've had this conversation with many VCs on, is how much time should you give to a portfolio founder? And I'll try to explain this with some context, right? So the context here is that a lot of my peers in the venture capital world feel that founders should have all the answers. And most of the times, founders should be able to figure solutions out rather than necessarily coming to an investor for help, advice, suggestion, whatever category you want to put that in. And I've had this conversation with many of my friends in the venture capital ecosystem that I fundamentally believe that for the first 4 years, 3 to 4 years of a company's life, a founder actually genuinely needs a lot more of your time over and above the capital. Which is also why a model like ours, where the kind of money we are offering is not earth shattering. Today, a lot of founders who raise $500,000 from us can actually easily raise $2 million from somebody else. But they're kind enough to raise that money from us because they're also able
Getting
to
your
get
time.
people, and there's a split down the middle where there are more people on the other side who fundamentally believe that having founders who figured it out are better than founders who need help. I think that's one, and the second, again, I think it kind of stems from this, but it's more a 1B where we have a very firm belief in incubating or co-incubating or creating businesses, which a lot of VCs again feel.
Because you're not, I mean, my observation, right, from my interactions with you, because you're not as concerned about IRR. Maybe you are, I don't know. But I think you also enjoy it, like
Yeah,
co-creating a business.
I do. And as I said, I think the reason for starting Whiteboard for both Sandeep and me came out of that personal need to try and build a few companies, co-build a few companies that we could,
That you're proud of
yeah,
and that
at
you
some
enjoy
point of
doing.
time be proud of, that we were a part of this, and which is also why, right, we've quasi incubated businesses. I gave you earlier the example of Apna Club. It's a quasi incubation because SAR, the original business, had shut down. One of the co-founders had to move on because she wanted to take up another job, so it was only Shruti and me, and we kind of worked through various ideas before we were able to bring in somebody I knew as a co-founder and create a completely different retail model by the name of Apna Club, which had no correlation to what we were building out in SAR. So those are the things, like if you were to ever kind of catch me and discuss things that I would say over the last 6 years that I've been very, I think those are the things that a lot of my VC friends feel, is they're not sure. The same way I'm not sure of the PMF of late stage investing to some extent, they are not very sure if there is PMF or scalability around what I'm doing with my time.
In investing in an idea stage.
In investing in an idea stage or trying to incubate a business where it is a lot of my thought that has gone into building it along with the founders.
So they may feel like because your thoughts are there with the founders, but you're not going to be there running the company.
I'm not going to be there, and I may not be there for long, and I may, what happens 3 years down the line, will the founder be able to think on her own? Like there are a lot of those questions which are very fair questions. I don't think we are at a point where I've been able to answer them because it's too early. Hopefully I'll have better answers, but I think those are places where we healthily disagree on.
Interesting. Hey, so what do you look for in founders? Like, what's something, is there a template for founder success? Someone who can give you like 1,000 crores, 5,000 crores outcome?
I think it's a mix of founder market fit, in the sense that is the founder built, so in isolation, right, every founder we meet we have very high amount of respect for, but is every founder built
For their market.
for a specific business that they're building? The fit is not always that clear or that straightforward. I think the other part that we look at more than everybody else is, for me, it's very important to spend enough time with the founder to understand where she's coming from, why are they doing what they're doing. As I was mentioning earlier in our conversation, right, that to me, entrepreneurship is the second most illogical choice.
So why are you making the illogical decision?
Yeah,
You want
so
to know
why
the
are you,
reasons.
like, to understand that why do you want to go after that extremely illogical decision? Why do you, like, and what is it that drives you? Because when things go bad or when things look negative, the only thing that keeps a founder going is the passion that made them start it. At times, somebody like me just needs to remind them that when I met you 4 years ago, 5 years ago, this is what was your driving passion. Is that passion still there or not? If it's not there, the business can't go anywhere. And if that passion exists, I am not worried about 6 bad months, 12 bad months, 18 bad months. Eventually, we'll come out of it. So I think the
You need to be really passionate about what you're doing.
yeah. So understanding the person and their motivation is something I try to spend a significant amount of time on. sometimes successfully, sometimes unsuccessfully.
I know a bunch of VCs, early stage, and I think this is a good thing, right? Where they're like founders good, yes, but also markets. Like, for example, you've been very clear that at least for your investing philosophy, like something like a hi-fi tech thing might not work.
Yeah.
And I kind of see why now. Like 10 years later, I'm starting to see, the VC point of view, right? Do you think markets are more important than founders?
Markets are important, and we've learned it the hard way. We've made mistakes with niche markets. So I wouldn't underplay, but I also think that if you've with the right founders, yeah, we've also seen us navigate our way through what seemed initially like a niche market to become a bigger play. So I think at times the founder quality offsets it, not always. You have to be lucky in equal measure to actually be able to get that trade off in your favor. Markets do matter, so there is no doubt about it. But I also think that how you approach the market matters a lot.
So you need to have an insight.
Yes, you need to have something that on which it's built. Now for example, and I'll take maybe 30 seconds here. We've been looking at businesses in OTT content for 4 years. Spent a lot of time trying to research what works, what doesn't work. We were reasonably clear we wanted to do something in regional content. We came across two businesses with very, very different underlying philosophies. One, the philosophy was that the average Indian user wants a quote unquote lower priced experience. So I'll keep my content costs low and I will offer this subscription of this regional OTT service at a lower price. And I came across another founder whose view was that whether a customer is sitting in a small town near Jalandhar in Punjab or sitting in Bangalore, that customer still wants high quality product because the exposure to content today is more or less homogeneous. Internet's fairly cheap, everybody has access to the same amount of data. So you cannot tell a customer sitting in a tier 5 town,
I will give you a worse.
I'll give you a lower quality content experience because you don't deserve better. Now, there's no right or wrong answer here. We've chosen the second one, and we've invested in a regional OTT platform which we've launched in Punjabi. We are going to launch in a couple of.
Are you very
markets.
bullish on regional OTT platforms? I'm actually very surprised that they worked. Like I know I've heard some success stories, Stage and all the others, right?
Yeah, so Stage is the one on the left that I mentioned, and Chopal is the one that we ended up investing in. And for me, the Chopal strategy fundamentally works. We have now almost 3 lakh paid users at a higher ARPU than Hotstar.
Yeah, that was a big googly for me. If you would ask me to bet on OTT content, I would have said no, nobody would pay for it unless it's like soft, bad stuff.
Yes.
But
So this is, and as I said, I think some of this has been learning for us as well. That was our assumption too. As we went deeper into those markets and went into those consumers. So I think knowing where you are placed in a consumer. So for example, in Chopal, we are very clear we'll probably be a customer's third OTT product. Will not be the first.
But that's okay.
But we're okay with that because we see like the shift we see happening, and that shift is very visible if you look at the number of set-top boxes being removed every month. That over a period of time, people's reliance on set-top boxes is going down. Everybody is moving to different forms of OTT for their consumption needs. So even if you're the third screen or you're the third OTT app on somebody's phone, it's absolutely fine. Doesn't matter. Over a period of time, there'll be a large enough market created with this third OTT screen as lesser and lesser people consume the old school, old media content, which comes to us through set-top boxes and cable TV, because that number is falling every single month. So it's I would say a more medium to long-term view that over a period of time, wherever a consumer is, the dependence on OTT for content and entertainment will be extremely high. Now, what you need to ensure within the regional ecosystem then is that for the markets you're serving, you need to be the content leader by a distance. You need to have, for example, in Chopal, 70% of all Punjabi content released is on Chopal.
But tell me this, right? Tell me in terms of like you're not very bullish on software as a service, or you're not very bullish on super deep tech from India. Neither are you bullish about consumer social. Why?
So one by one, right? So consumer social works on MAU, but the MAU to monetization journey, going back to our discussion
MAU
of
for the audiences.
so basically you have these monthly active users who actually come to the platform and
So you'll have a
consume.
lot of users.
You'll
only,
have a
yeah.
lot of users, but to actually make money goes back to our earlier discussion on the Indian demography being a little narrower skewed in terms of people who genuinely are the haves or can pay, which fundamentally means that you need to have a premium service for the top 2 crore, top 3 crore, top 4 crore Indians to pay for it. But the bottom 100 crore of India
Will
or
use
bottom
the service
80
but
crore,
not pay.
yeah, may watch your content, but it's very difficult for you to monetize either through advertising or otherwise from that user. So I think this, like the social play, right, fundamentally works on your ability to be able to monetize
The top.
And for the top, if somebody comes up with a very differentiated social experience, yes, it can work. I have actually seen most of the social products that at least have been pitched to me have been volume plays, have largely been sold around high MAUs. The proportion of monetizable audiences from that high monthly active users, in my narrow view, is not that high, which is why I have skepticism with respect to revenue generation.
Also, I have a thesis around building a social network for the top, right? I mean, that was the original thesis of my last company. It's you're competing directly with Instagram and Facebook and Twitter.
Yes.
And it's just so hard. Those network effects. I mean, even Mark Zuckerberg is trying Threads now, right?
Yeah.
With Instagram and WhatsApp behind, and still not working because it's really, really, really hard.
Yeah, and see, network effects, right? Again, goes back to that.
Can you explain network effects for the audience?
So fundamentally, a business with high network effects fundamentally is a business which where the growth loops of the business are directly dependent on how strongly the existing network communicates using the product and is able to bring more and more and more users to the platform. So fundamentally, you are able to build a vicious network of people who cannot, for whom a part of their life
Is Twitter or
depends
YouTube?
on their ability to be able to use that network. And again, I think I'm not saying it won't happen. As Whiteboard, I doubt that a founder who's building a very strong network effects business will raise money from Whiteboard.
And I mean, we haven't seen one single success of social media, top tier social media in India.
Yeah,
because
we haven't. And as I said, I think even if we see the amount of capital that business will require, even to get off the ground,
is probably 100 million.
is going to be in at least tens of millions, which takes me as Whiteboard out of the equation. I hope it gets built out of India, but I don't think it's the most relevant space of inquiry for me, given my constraints of my fund size and what kind of deals I can
And
do.
we should have seen at least one success by now. Good founders have tried.
A lot of very high quality founders have tried. A lot of different things have been tried. A lot of high quality models that worked in other geographies have been attempted, and as I said, as you rightly said, by founders who are extremely high quality. As I said, never say never, but I do think that there is a, whether it happens or not, I'm not too sure.
What about SaaS, software as a service, where you're selling a software product for $9 or $20 or $100?
So I think in basic sense, right, I think, and SaaS, just kind of to nuance it slightly further, software as a service can be sold to enterprises, can be sold to small and medium businesses, can be sold to individual consumers, can be sold to creators like you as well as individual users. Canva is a very good example of a software product which started with a certain kind of users. So my view on that again goes back to we are by design um, programmed to see size in an opportunity. As
You're talking
venture
about VCs.
capitalists, we are supposed to see quote unquote large outcomes. We discussed that in the earlier section. Now, for that large outcome to happen in an SMB or small and medium business scenario, the number of businesses you require paying you that kind of money, selling to India, I think is a very difficult task. There are some businesses in our portfolio that are SaaS platforms selling on the Shopify ecosystem, some selling in the US. I see the opportunity sizes there, but I also think it's a very hard grind for every $1 million of annual recurring revenue or ARR as we define it to come into those businesses. Now, does it mean none of them will play out? I don't think so. But if you again look at it mathematically, you need $100 million of annual recurring revenue for, again, given sane business valuations, for a business to be valued at $1 billion. To get $100 million of annual recurring revenue, so even if it's $100,000, so you actually for $100 million of revenue, you need 1,000 customers. That in itself is hard. Now, all of a sudden, if you change that 100,000 to $100,
Then you're
and do the maths on how many people you need to sell this to become a, and again, there have been successes in that space, and hopefully there'll be more successes that will come out of that space. I basically think that genesis of India as a technology ecosystem has come out of our cost arbitrage and services potential.
which means that I can hire somebody, an engineer here for like 3.5, 4 lakhs an annum at a services company.
And that engineer will be able to deliver similar or maybe slightly inferior offering to a company which is offering. So I think all of us probably have read some stuff about how ecosystems come into play, right? So the Indian technology ecosystem started with the Infosys, the Wipro, the TCSs of the world, which were built around our operational and service efficiency. They were not necessarily, and I'm saying, I'm making a brushstroke remark, but I'm just saying they were not high-tech product companies. So a lot of, like, basically, see, it's that circle, right, of where your high quality talent comes from. If it is from process efficiency, if it is from services businesses, you fundamentally understand that that's something you'll do really well. But how many high quality tech product companies we've seen? One. Second, 85% of the Indian high quality tech product talent chooses to work in the larger global Western companies. So I think that the shift towards us being able to create extremely solid viral products will happen. But I am not sure if that is something that will happen in the next 3 years. Maybe it'll take slightly longer.
And what do you think about selling enterprise deals to India? What I've learned about selling enterprise deals, like software enterprise deals to India, is they eventually become services companies. Like I've seen this, like actually you can see like some companies like Darwinbox, they're doing fairly well. Tally's doing fairly well. And not just them, right? Like plenty of other companies. Once you start digging and double clicking, you'll find quite a bit of a services
See, I think
layer.
the question, right, and I think that's a metric that I think now is globally accepted. I think one of the things that you should always look at, right, is how strong is your revenue per employee. So if you are a tech product company and you have 8,000 people working, clearly the two are not gelling because you don't need 8,000 people to run a product company. If you are a tech product company, most of the global tech product companies are very thinly staffed. The revenue per employee
It's huge.
is massive. And I am, again, I'm saying this with enough amount of ignorance. I'm sure there are businesses in India with very strong revenue per employees.
Hmm.
But a lot of the larger grown-up companies that I have seen in the software side have also had a large number of employees for the revenue that they bring in. And if revenue per employee is not high enough, it basically means there is some part of your business which is not fully productized, for which you need a service delivery team to handle customer queries, responses, whatever that means. As I said, I am confident that there are, and because I keep talking to a lot of my VC friends who have a strong view that India, SaaS from India, whether it's for the world or for India, is a very, very large opportunity. And I see the macro trends. But for me to see a company genuinely deliver, the metric of revenue per employee for a scaled up company will be a very interesting metric to see. I'm not gone deep enough on that, but probably as a follow up to this conversation, I'll actually do that and try to see which are the companies with very strong revenue per employee for me to kind of see that they could be the next product heroes, software product heroes from India.
Awesome. So I have one last question for you. Okay. Sorry for keeping you for so long, but it's just the rate of insights is pretty high. Last question for you. Have you angel invested?
Nope.
What do you think somebody who's looking to angel invest should think and do? I've been angel invested in a few companies. I've just lost my money on all those companies. Very small checks compared to a VC.
So I think first step of angel investing is knowing that whatever you invest will not come back, should be okay with it. Second, there are categories of people who angel invest, people who work in a professional space, people who are full-time angel investors, people who run syndicates. So depending on where you are from, so if you're, for example, working somewhere and you have some knowledge that you can, like angel investing only to make money, I think it's very, very hard to make profit from angel investing as a career. People have done it, but if you'll meet 100 of them, maybe 2, 3, 4 would have been able to
So there's strong
successfully make
survivorship
money.
bias.
Yes, but if you come from an industry and you come with learnings that you think can help a founder build better, but you're in a position where you, for various reasons, do not want to be a founder yet, you should angel invest in areas you understand.
Just to get some insight.
Just to get insight, share insight, learn with collective wisdom. Again, not investing for the sake of making money.
So you invest, let's say, a few lakhs, but you're getting to learn a lot more.
You're getting to learn a lot, you're getting to teach a lot, you're getting to have conversations with somebody who's interested in similar spaces as you are. For example, you have very high interest in AI. You find a founder who you think you can jam with on concepts that you've not thought through or concepts that you want to discuss. So you invest more the same way you'll invest in a course for yourself to upskill.
To be able to directly text the founder and be like,
to be able to have a conversation which you feel enriched after. But if you invest for the sake of making money, I think it is very, very difficult. The law of averages a lot of times plays against you.
What's the minimum number of companies you need to invest in to start seeing a return? Like 100?
No. So I think bare minimum, I would say 20. So if you, and again, the one thing which is very important, if you genuinely choose to angel invest and you have, let's say, a corpus of money which you're okay to lose. Let's say that corpus of money is 1 crore rupees that you're okay to lose fully. Then if you're going to make 20 investments, you need to be disciplined enough to say, I'll make 20 investments of 5 lakhs each. You cannot pick and choose and say, this one I'll put 25 lakhs in, the other one I'll put 2 lakhs in, because genuinely speaking, you don't know which one will work.
Even if you have high conviction,
it doesn't matter. See, at your level, until and unless, as I said, you have some significant information arbitrage. If you are a
where you know they cracked some government
where you
deal
know they
or
where you know that this specific technology, given your domain experience, you have a very strong view on that this will be the next big thing and you're willing to bet your house on that, different. But as a routine angel investor, invest the same amount in every company so that you don't suffer by your own decision making. Because now think of it this way: you invested 20 lakhs in a company, it goes under. You invested 2 lakhs in a company, it went to 10x, but it still returned 20 on a portfolio of 1 crore. You're still under. Because genuinely speaking, and I'm saying, I say this as somebody who's running a fund, it is, I'm not even say hard. I can't tell you the day I invest which of my companies will work. I believe, hope all of them work. It doesn't happen. So, and I do this 24/7 or whatever number of hours I work in a day. Even then, and I've been doing it for 6 years, and I've been seeing this for 12, 13 years, I still have, whenever I make an investment, I'm extremely nervous because I'm not sure if it will work. So I think that discipline in investing and discipline in exiting are the only two things that I've learned. Some by doing the right things, some by doing the wrong things. If an exit is on the table and you choose not to take it, you should have thought long and hard about it. It doesn't matter whether it's a 3x, 5x, 6x, 7x, whatever, because it can become zero yet again. So if you've not considered that possibility, then you are fooling yourself. So staying disciplined as an investor, and probably the same advice you'll hear from a lot of public market investors. Every single investing book starts with the word discipline, ends with the word discipline. So ensuring that you are disciplined about your approach.
Interesting. What's the, paint the positive case for Whiteboard? Where does it go if everything works according to plan? Next Sequoia?
Not at all. I don't think we'll ever raise a fund greater than the current fund size, because I think I have an Excel sheet model at this point of time on the basis of which I can give the returns that I promised to investors on this size. I don't have one for a higher amount, because what Sandeep and I enjoy is investing at this stage. That is, like, I'll never take the fun out of what we do. So which is why we'll always invest at this stage. So the positive case for me is that we are able to build a few companies that remain relevant for a longer period of time. We create some brands, both online and offline, that stay beyond the size of our funds. And obviously, needless to say, we are able to return whatever we promised to our investors. But the best case scenario for Whiteboard probably is maybe 3 more funds of the same size.
What's a failure case? I mean, one thing we do on this pod, which is like very weird, is like a lot of people believe that founders or VCs or whatever haven't thought about the failure case. You know, when the media comes out and says, oh, these people have failed, or these people will fail, or Kunal Shah has raised so much money, you know, where is the profit model, the company is going to fail. It's like every founder I've met, they know that there is a failure case. But sometimes them enunciating the failure case on a podcast is just very useful.
So I have 2 failure cases, right? So the easier failure cases, I don't raise the next fund. That's still easier. The harder failure case is that I'm not able to build a single high quality company from the current capital that I have. And again, as I said, there are failures always in shades. So I think this is extremes. But in extremes, if I'm not even able to build 1 company, 2 companies that I'm proud of from this fund, that's a significant failure case. Us not being able to raise the next fund in itself
will be a reflection of this.
But I think in different shades, both of them are kind of failure cases for Whiteboard. But I think I can't kind of think of anything else.
Awesome. Thank you so much, Anshu. I learned so much.
Perfect. Thanks a lot, Varun, for having me. I think
sorry for me taking 2 hours of your time and just like slamming you with questions.
No, I've never done this before. You mentioned that right at the top. I've never done this before. I'm not sure if I'll ever be able to do it again. So, but
no, it's lovely. You should do it again. 6 months later, we'll have you on again. All right, ladies and gentlemen, hit subscribe. Bye-bye.